Okay, can you guys see my page? Oh, shit. Okay, so I'm gonna get started. Oh shit. This is my first time using Zoom. I mean, like, presenting. Okay, so let me just go over what a moving average crossover strategy is. So a moving average crossover basically takes takes price data and then like averages out like a certain number of days. So I think the picture on the right really gives a good example of what a moving average is. So you can see here, like, so you take 280, you take 356, you take 486, and then you add them all together, and you get 374, right? Because it's just the 3 day. So this would be a 3 day moving average because it takes the past 3 days of data and averages it and computes and puts the average over here. Oh, hello. Okay, so so now that you know these moving averages, how do you create a strategy out of it? Well, for a moving average crossover strategy, you usually buy and sell assets based on when the lines cross. So you can see a good example of that on the left. So this is like one moving average, this red line. This green line is a different moving average. And they look different. They're different moving averages because they use different number of days. Like so this one probably is like 50 days, and the red one's like 50 days, and which means it takes the past 50 days, averages it, and takes that value and graphs it on this chart. And like the green would be like the 20-day. And you can see that there's crossovers. When the red and green cross, you see here, one here, one here, and one here. And when they cross over, that usually signals to the trader whether you want to buy or sell. Okay, so I already sent out a, does everyone have these packages installed? Yahoo Fin and trace.logger. Can you like put a yes? Well, I mean, like, if you don't have it, could you download it right now? Okay, so if you guys already downloaded it, okay, so I'm gonna start coding. I'm gonna go to another screen and start coding out the strategy. Okay, so can I can you put a yes if you can see my screen? Okay, thank you. So the first thing I'm gonna do is create a new Python file. Okay, so first things what we're gonna do is do some imports. Yahoo Fin. So Yahoo Fin is a third-party library that was written by someone. His name was like Andrew something. I can't remember. Doesn't really matter. So inside there's a file called stock info, and then there's a function that we want to import from there, and that would be get data. So that is a function that we've just imported from the Yahoo Fin library. And we're also going to want to import trade.logger. And that will allow us to create, and that will allow us to log trades. Okay, so yeah, I'm just going to copy some of this stuff. Like it's just like we're gonna. Okay, so let me just go over what. So right here we're creating a function. So we're gonna compute the performance of the moving average. That's what this is here. And so ticker. So what are these parameters? So tickers. Ticker is basically a stock symbol. So with moving averages, there's this concept called momentum and resistance. Well, like. Momentum is usually like shorter days because like you want to get like shorter term. You want to measure the shorter term momentum. I mean, no, that I just okay. Wait, no, it's good. Okay, let me try this again. Okay, so momentum is like a shorter time frame because you want the shorter time, you want like this momentum to like be more responsive to recent changes. So if you look here, this green line is like shorter. This green line would be like the momentum, right? And when it like, and this red line would be resistance. So when this green line like surpasses the resistance, then you want to buy because like your momentum's past the resistance. Like resistance is like sort of like what keeps the, I don't know, just like holds back the stock price or something like that. It holds something back. Oh, hi. Yeah.
Oh, we can only see the IDE. We can't see the graph you're talking about.
Oh shit. Yeah, I hate Zoom.
But so momentum and resistance, they're just moving averages with different amounts of days.
Yeah. So momentum is usually shorter days. All right. Someone just came in. Hey, Robert, you didn't really miss anything, so don't worry about missing.
Oh, okay, cool. Thank you.
Okay. So yeah, momentum is usually shorter days because you want the momentum to be more responsive to recent events, while resistance is like something more long-term that you want the momentum to pass. It's like a rubber band. Like you pull back a rubber band, and like you pull it, keep pulling it, and it develop like it not snapping. Like it doesn't snap because of resistance, but I know this is a terrible analogy. Okay, whatever. So yeah, just think about momentum being shorter term, and you want to trade like when shorter term. Okay, yeah, yeah, okay, whatever. Just momentum is just shorter number of days. Okay, so let's just leave it at that. Okay, so the first thing we're gonna do is like if ND's momentum is greater than ND's, you want to like raise value. Oh, we have a lot of people who just came in. Okay, so since there's a lot of people, okay, can you put up a no button if you don't know what moving averages are? So if I see any no's, I'll explain it again for whoever just joined. Okay, there are no no's. Okay, so if your momentum is bigger than your resistance, that doesn't make any sense because you want momentum to be a shorter time frame. So you want to raise a value error. It's like, please have ND's momentum be less than days are. I didn't write down the full variable name, but just to save time. And when you raise a value error, it's basically throwing a Java. It's like if you already taken Java, it's like throwing exception in Java. Like, so like say you have like a Fibonacci algorithm and someone puts in a negative number, you'd want to throw an exception then because Fibonacci doesn't work with negative numbers. Okay. So the next variables that I'm going to talk about is start date and end date. So you like when you implement a strategy, like you could do it from like the beginning of the stock market to the end to the current stock market, but you can also select a certain time range, like a year between July 24th, 2016 to July 24th, like 2018, like it's a few years after, like a few years time range. And so these two variables will signify the time range. I'll go over what the other two function parameters are later. Okay, so first we want to get the data. So so earlier we imported the get data function, and that basically allows us to get data for a stock. And we tell which stock it is using a ticker because the ticker denotes a symbol that represents a stock. And then we also have to, indicate the start dates equals start. So like right now we don't have a value for those, but later we're gonna like call this function with like we're gonna call it something like this, and then you're gonna put like some day, like 01, 01. Yeah. With like 2 more things. Okay, so I'll just leave this blank for now. Okay, so after we get the data, we're gonna have to create like moving average bands. So we're gonna copy it. Oh yeah. So for the get data function, we get it in OHLC format, and we only want the open because like, yeah, let me explain this. Okay, so okay, so oops. So we only want to get the open data because it's like, so the data we get is in OHLC format. And what that basically means is it gets the open, like when the stock market just opens, what the price is of that stock at open, the close, which is what the price at which the stock is at when the stock market closes, the high, which is the highest value in the day, and low, which is the lowest value in the day. And you only want to use can you guys see all the text? You guys don't see anything weird, right? Oh, shit. Okay, so we only want the open because like we don't want to have look ahead bias. And look ahead bias is where you like use data. Say you're trading like in the middle of the day. So you have an algorithm that trades at the middle of the day, but you use data like at the end of the day, like close. Then when you back test your strategy, it won't be accurate because you're using data that you won't have yet. But if you do it at the open, it doesn't matter what time during the day you trade because the open is at the beginning of the day, and like low, high, and and like these other like values don't matter. I mean, like you might not have the high or low yet, but like in the middle of the day, and you definitely won't have the close. But if you use the open, you will always have the open price, and you'll always have the you guys can read. So you always want to use the open. It's hard. Okay, this hard. Sorry, I'll get better at this. Okay, so you always want to have the open price to avoid using data that you don't have yet. Okay, so I'll just put it out. Okay, so so if it's an open OHLC format, this is how you do it. You access it with like a column index. Oops. And so now we have only the open column with this call. And so now we have to, so now let's create the so right now this is like a column of data. It'd be like something like, I don't know, like 101, 102. Something like that. So like price series. So now what we want to do is create the moving average things. No, the moving averages. Okay, So right now let's do the resistance first. Okay, so rolling basically takes like the past 5 days and like no, past like number of days that you specified. So right now, so end days resistance, because this we're working on the moving average for the resistance. And rolling basically like aggregates the last 5 days and then goes to the next day and then looks back 5 days. And then the next day, it's the end days resistance like 5, say for example. And then when you go to the next day, it like takes the past 5 days and then like sticks into like some rolling object. So however we want to have since we want to have the average, we can do the dot mean, and this will give us the rolling average over like the past n days of resistance. And for momentum, we just do the same thing. Oh yeah, if anything doesn't make any sense, feel free to unmute yourself and like tell me. Okay, so let me go over some things about like actually one second. Okay, next one we will have just like, you can think of it as like the daily, which could be sort of thought as like the like the rolling average of 1 day, but yeah, whatever. Never don't listen. Okay, so right now what we want. So something I'm gonna do something here that might be a little confusing at first glance. So I'm gonna slice all these. So I'm gonna slice all of these for end days resistance, because if you remember, when you do a rolling average, you take the past, like say you're on the 5th day, you take the past 5 days and you average it, and then you put the value at that 5th day. So what happens is like the previous 4 days, they all become nan, because like it doesn't make sense. Like for a second day, you're on the 2nd day, you don't have 5 days yet for a moving average, right? So all the 0 to 4th values would just all become not a number values, like double dot no, like some not a number value. So in order to avoid using not a number values in our computations, what we do is we take the largest value of the moving average, because like say you have a 5 day and a 10 day, you want to get rid of the 10 days. You want to get rid of 10 days for both the 5 day and 10 day when you're doing crossovers, because you want them to line up, where not on the same day, on every day that you compare them, there are no not a numbers in the computation. Okay, so now what we want to, so that is what I'm doing right now. I'm just lining up all the data frames. And data frames, you can just think, if you guys don't know what a data frame is, the data frame is what this get data returns. And it is sort of like a matrix. Like if you have a 2-dimensional data frame, it's basically a matrix where you have a bunch of rows and columns, and each of the columns have like a name. So just think of it as like a Java 2D array, but with like extra information. Okay, so I have, okay, so now, oops. And so in Python, the way you usually slice things is you do the start index, then you put a colon, and then the end index. So yeah, that's basically how you do slicing Python. Hopefully you guys know the basics of Python, or else this will be slightly more difficult. Okay, so the next thing is we want to do is like, we want to create a Boolean value called prev. So we want to create momentum prev below. Okay, so mom for like momentum prev below previous, like the momentum was previously below the resistance. So what we're going to use this variable for is like when you have a moving average crossover and the momentum, you want to buy when the momentum surpasses the resistance. So what this variable tells us is if the momentum was previously below the resistance, because when you want to buy, you want to buy it when it was previously below, then surpasses it. Because that's when you know you like pass the resistance. And that was what the variable is for. Okay, so right now we're gonna do an iteration. We're gonna iterate over every value of the resistance, momentum, and daily. The momentum, sorry. We're gonna iterate through every day of the resistance moving average and the momentum moving average. And when there is a day where the momentum exceeds the resistance, we will issue a buy signal. So we can choose any of these data frames because earlier, as if you remember here, we sliced them so that they are they are all the same length. So you can choose MA resistance, or you can choose MA momentum, or MA, or just the daily. And length is a function in Python that measures the length of something. And so val momentum. Let's just do momentum. Okay, so what this basically does is we get the X index in the MA momentum data frame. And so iLoc stands for integer locating, I think. So like that's how you get the X item. And so we're gonna get the momentum value, then we're gonna get the resistance value. And we are going to do a bunch of if statements to compare these values. So if momentum is greater than the resistance and you were previously below the resistance, that means the momentum is surpassing the resistance at that moment. We want to issue a buy signal. Okay, so how do we keep track of buys and sells? Well, here we've imported a TradeStat logger thing earlier. So right now I'm going to create a logger. Logger equals shit. So this is simple logger, and simple logger, yeah?
Really fast, what is the ILOC? I think I just blanked out for a second when you went over that.
Oh, it's like an integer location. So like, are you familiar with Java?
A little bit, yeah.
So, you know, like when you index a value in Java, you use like an integer. It's basically like it's like integer indexing. iLoc is integer indexing. So right now we have like so there's 4 columns, right? Like right here.
Yeah.
So there's 4 columns: open, high, low, close. And here, since there's dynamic, there's no static typing in Python, so I can do. Oh shit! I actually screwed up here. So we take one of the columns here, right? Because like the open column. So it's like a sort of like a 1D array, right?
Yeah.
Can you think about that?
Yeah, okay. I
so
kind
like
of get it.
Yeah. So, and then to access the first element, you do like dot iLoc 0. Does that make sense?
Yeah, okay.
Yeah.
I gotcha. Thanks.
Okay. Yeah, I really like it when you guys like unmute yourselves, because like it allows me to it gives me an opportunity to like explain something that might have been fuzzy. Okay, so logger, let's create a simple logger. Okay, yeah, just a simple logger. Okay, so, oh yeah, we're also gonna want to have a value called position size. Okay, so what position size will tell us, so we're gonna keep track of how many stocks we buy because we don't wanna have overexposure. Like say you have a portfolio, let me explain what overexposure is. So say you have a portfolio, is it wise to put all your money into, like, say, AMD? Unless you have autism and you are trying to get karma on Wall Street bets, it is probably a terrible idea to put all your money on AMD. So by keeping track of position size, we can limit how much stock we buy we don't want like of a million shares of a stock. We only want like a couple thousand, or like in this case, I'm just gonna set it to like 100. So we're gonna keep track of how many stocks we own so that we don't buy a million shares. Like say if there's like continual buy signals, like we don't want to buy a million shares of like one stock. That'll cause overexposure. So, and position size is less than like, say, less than 100. Okay, or let's do less than 200. So if we want to buy, okay, so now we want to log a trade. So logger, we created a logger before. You saw that logger equals simple logger. Then you did the log, wow. And then, give me the keyword values. Sure. Okay, security. So what security do we want to buy? We want to buy the stock. So you input the ticker. And then we want to determine how many shares we want to buy. Let's just do 100. We're just gonna buy 100 on it every time we want to buy it. Share price. So how do we get the share price? We get it from the daily. So like current price. Daily. So say if you guys remember earlier, daily is just like there's no moving average applied to it. So like say we're on the 5th day. No, like say we're on like the 100th day and we have like a 5-day moving average and the 20th moving average and they cross over or something. The daily is just the price on the day, or like it's just the price of the every day. So current price. So what this does is we give the logger some information. We give it what we want to buy, the ticker, how many we want to buy, and number, yeah, and the price of the and the price of the stocks we're buying. And and so we just bought 100. So what do we want to do? We want to increase our position. We want to indicate to the position side that we bought 100. Okay, so now how do we know so we buy a bunch of these shares, right? So what would be a problem if we just did this? If we left our algorithm like this, we'd never sell our stocks. We'd only buy stocks. And like, if this algorithm ran forever, we'd buy like probably the entire company. And that would be very bad because we don't want to buy that many shares. So now what we want to do is create sell signals. So here, earlier, the if statement, here is a buy signal. So how do we know when we want to sell? So this is what I'm going to go over. So when momentum, so let me go over the next thing.
Hey, really fast.
Yeah.
So I'm really new to Python, so
Yeah, go ahead.
if our position size is going to be less than 200, does that mean we can literally? Wouldn't that just make it like we can't buy a company into a company more than 2 times, or is that how?
Oh, sorry. Here, let me rename it. How about this? Position size, number of shares bought. Wait, shares owned. Here, how about that? So this is how many shares we own. So like we can only buy 200 shares. Well, like technically 300 because if we had 200, we can only buy 200 shares. Does that make sense?
Okay, so would that mean every time the criteria is met? So I'm just trying to figure out like how often does the 200 like recycle? Does that mean like it's on a daily thing, or is it like so we essentially can only buy into a company 2 times then, because if we're buying, our position size is going to be 100 and
Yeah, that's
our
the point.
shares owned can maximum be 200. Am I just, I know
No,
this
no,
is
no,
an
no.
example, but
I understand what you're saying now. So you're saying like we can only buy 2 times and then we can't do anything. Is that what you're saying?
yeah, I'm just curious if that's kind of the example, just so I can understand it. I totally understand this is an example.
So like like in real life, there is no limitation to how many shares you can buy, but we're just
Right.
limiting the number of shares that we can buy that we own so that we don't overexpose ourselves. Like say you have like $100,000, you don't want to put like buy with that $100,000 as many shares as you can of AMD, right? That'd be a terrible
Yeah.
idea.
Okay.
But
So,
later we're gonna sell the shares, so that allows us to buy more. So like we aren't limited to buying shares twice. What we're gonna do later is sell these
oh,
so we can
okay.
buy more later, right?
Okay. So, but at a time before we sell, we can only have bought in twice.
Yeah,
Okay.
that is true.
Perfect.
Yeah,
Okay.
yeah, yeah. Great question. Yeah.
Sweet. Thank you.
Okay, so
So I have a question.
yeah, yeah, yeah. Go
Why
ahead.
should we ever sell if stonks only go up?
That is a great point. Um,
Okay.
let me think about
Sorry,
it.
carry on. It's a joke.
That's true.
You're doing a great job, by the way. This
Oh,
is
thank
cool.
you.
Are you gonna like put up the recording or something or the code?
Oh, I'm posting the code into the group chat. After
Okay.
we
Yeah.
finish.
I would
Dope.
love the video too. Just
Yeah, yeah, yeah. I'm also
go back
recording
to
it, so I'll also post the video somewhere.
All right. Great.
Sweet. Thank you.
Cause I don't post the slides beforehand and the code beforehand, or else I'll be unemployed, and I do not want to be employed in this current times. I'm getting paid. I'm getting paid $0 an hour, but you know,
Understandable.
$0 an hour is what they make in Thailand, anyways. Okay, so how do we know when we want to sell? Okay, so we want to have a threshold value. So earlier we saw here threshold ratio. In Python, you can, so when you have a keyword argument, you can just set it to some value. And if the user doesn't specify a threshold ratio, what it does is it automatically just sets it to 1.3, if you can see here, 1.3. And so we have, so what we want to do is like when the momentum reaches a certain, like is 30% higher than the resistance, then we want to sell. The reason we want to do that is because like, think about it, like if momentum is going high, it will eventually go below the resistance. But we don't want to go too low because then we'll start losing money. So what we do is we like sell it off when it reaches like a threshold ratio, which is 1.3 here. Let me just make it clear. Threshold 1.3. So okay, so when the momentum is like 30% higher than the resistance, then we want to sell because we want to buy low and sell high. You know, it's just that simple. You know, that's why. Like, just listen to my advice, and you will become a millionaire overnight. Okay, so and shares owned is so what this basically allows, so the reason I put shares owned is oh yeah, wait one second. So the reason I want to put share zone is greater than 0 is because I want to only sell stocks when I own. I only want to sell them when I own them, because the thing is, like, this is not a short-based strategy. So we do not want the shares owned to go below 0. Okay, so now we're going to log shares. So how do you indicate a short with the logger? You indicate that you're going to have negative 100 shares into this portfolio. And the share price is just going to equal to the current price. So right here, we have the momentum is previously below resistance. So we're going to do is momentum previously below resistance equals false. The reason momentum is previously below resistance is false, because when momentum surpasses resistance, then it is no longer previously below it, because currently it is above it, right? And momentum, same thing. Well, since we're selling it while momentum is still above resistance, we're still going to set this to false. Oh, shoot. I forgot I accidentally did not do an LF here. So this LF stands for else if. It's okay. So another. So here we have a sell signal when we want to cash out. However, this only works when the momentum keeps going up. So what happens if the momentum goes down and it just keeps going down? We don't want to do nothing and let the stock hit 0. So what we're going to do is create a sell signal when the momentum goes against us. So if momentum is below resistance, then we want to sell. So something you might notice here is oh, okay. Sorry. Okay, something. Oh shoot, I forgot to change the share zone. So something you notice here is that these two are just basically what happens is the moving averages are super close to each other. You don't want to suddenly start trading a whole bunch. That'll just rack up a bunch of fees, and it'll cause a lot of slippage and all these bad things. So we're gonna add an arbitrary ratio, bandwidth. So here earlier we defined bandwidth as bandwidth. You can see here I set bandwidth equals to 1.05. And the reason we want to have this bandwidth is because we don't want it to just rapidly trade, because these two if statements are super close to each other. So if the moving average was super close to each other, then it'll just generate a bunch of trades. So we're going to add this bandwidth to the momentum so that the if statements have some distance from each other from when they will execute. And that will, so 1.05 will just mean that momentum has to be 5% higher than the resistance. Okay, so now we want to, again, since we are not implementing a shorting strategy, since we are not implementing a shorting strategy, we will not sell shares short when we don't own shares. So, okay, hopefully you guys know all what shorting is. But if you don't, it's like when you don't own any shares, but you borrow shares and you sell it, and then borrow shares from a broker. Say you have not Robin. You have E-Trade or something like that. You borrow shares from the brokerage, you sell it, so you have you basically have negative shares, and then eventually you buy them back, and then you return the shares back to the brokerage. And so that kind of strategy tries to profit off of stocks going lower. So say they're in some scandalous time, they say they What's something stupid that a company can do to lower their share price?
Didn't Zoom do a thing where they had bad security and then stuff happened?
Oh, that is a great example. So like if you somehow knew that Zoom was gonna like be revealed to have bad security, you can sell them short, and like you hope that their stock price goes lower, and then you buy them back. So you sell at like $10. Like say Zoom is $10. I don't know what it is. Then like they drop to 8. So you sold it for $10. So you sell like 10 for 10. So you got $100. They go to 8. You buy them back for $80. You give the shares back to the brokerage, and then so you sold them at 80, and you sold them at 100. You bought them at 80. So you like make like $20 per share. No, whatever. You get the point. You make money. Actually,
Are you gonna like back test this now, or?
the logger will automatically backtest.
Okay.
Well, like we're doing backtest right. This is the backtest right now.
Is this strategy any good?
If it would, no.
Okay.
Actually, it can be good. No, I'm just joking. So,
Okay.
according to Ernest P. Chan, which is a person who does like stuff similar to this,
Mhm.
he says that like these types of strategies, everyone knows it, right?
Yeah.
Is this some like secret, super good strategy? I want to be teaching this to you guys right now, right?
Right. Makes sense.
Well, but, I'm just kidding. But like, so everyone knows this, but so what they do is they add other stuff, right? Like they alter these strategies, right? So they add
Right.
something like they add news, like so you have the moving average crossover, and there's positive news on that day.
Right.
Right? So you add some adjustment to make it different from all the other algorithms everyone's trying to run
Right.
on the same strategy. So you
Okay.
add some additions to it to make it profitable. So right now we're just establishing baseline.
And do you understand like all the math that goes in here?
This is technical analysis, which means this is like voodoo bullshit. But
Okay.
so for this, you bring up a good point. So I was just joking about the voodoo bullshit. There's a lot of like jokes about how technical analysis is like some voodoo magic and it doesn't actually work. Like, so yeah, it can be true, but like, so what moving averages is basically trades off like the shape. You think about like it has ups and downs, but the moving average creates like a story or a shape out of the price series. Like say, if you guys know what a price series is, it's like an XY plane where X is a date and Y is the price of the stock, right? So you have this price series, and what moving average is sort of like creates shapes out of the price series, and then like the crossovers might tell a story, and like maybe there's like some shape patterns, like maybe stocks have this exhibit a certain shape or pattern throughout days, or even on certain days like Fridays. Like I'll go over why Fridays. So it exhibits these certain shapes, and the moving averages can capture these shapes because the moving average is dependent on the price series. And when you have these shapes and these stories, like it might tell us something about what will happen to the stock based on the shapes right now. And so something interesting I read about the Renaissance technology, which is like the best quant firm. They like average about 70% returns per year. Isn't that crazy? 70%? Like the S&P is like about 10%. But think about it, 70%. Like
Pretty good.
that's crazy, right?
Yeah.
And like there's not a lot of funds. And so the Renaissance technology. You guys, I'll just put a comment here. It's a hedge fund. It's like, if you guys know, so what they do is like they try to find shapes on certain days, like Fridays, Thursdays, like because like there might be different psychology and behind the like the traders. And like say it's a Friday, you have different psychology when it's Friday. You're like, hell yeah, I'm off work, no more, or you're like, no more school. And so your psychology is different, and thus the patterns you apply the actions you take when you look at the stock market would be different because you are in a different state of mind.
Right.
And so what Renaissance technology does is they capture these types of patterns that they see on, say, like a Friday when the investor psychology is different. They manage to capture the paradigm and predict what will happen to the stock price on and trade. And that's why they were successful. They just use these weird stuff, you know? That's kind of weird, you know? Like, okay, so yeah.
Sort of on that note, with this package, can you also pull like fundamental data like EPS and stuff?
Oh, that is a good point. You cannot pull historic. Here, let me show you how to get. So, Apple PE. So I've posted a link to the resources in the Google Docs where it has like the documentation, if you guys want to check that out. So, oops. Yeah, you can get PE. Here, let me show you how to get that real quick. So you get the quote table. Quote table is like a bunch of random stuff. So get quote table, you specify the ticker, and then like it gives you a dictionary. And how do you get PE? I can't remember. It's something like PE or something. I don't know. This is how you get market cap. That's what I know. I think it's something. Can't remember actually. It's something like this. Here, let me change it. So you can't get other data, but it's not historical data. It's super hard to get historical fundamental data these days. But the thing is, like, you can use a Quantopian. If you guys don't know Quantopian, it's a backtesting algorithm. No, it's a backtesting platform where you can test different strategies. I tried using it. I don't like using it. That's why I'm using trace.logger right now. So, but you can get historical PE data through different pipelines in Quantopian. But if you want to get like current, or you can just try to, there's also spreadsheets that you can get from Morningstar. Let me check it out. Morningstar. You can probably download like a Excel spreadsheet or something like that for a company if you want to get historical PE data that way. But Yahoo Finance does not let you get historical like fundamental data. Okay. I spent too much on that. Okay, so now we have a strategy. So okay, so let's test this baby out. Oh shit, I forgot to return the logger. So we want to have the logger object because like it stores all the information. Yeah, let me. Okay. So let's call this MA25. Let's do something bigger, like 2000. MA20.
What's 20 and 100?
What's the moving average?
Okay, gotcha.
Moving average. Oh yeah. Here, let me do the keyword. Okay, does anyone have any questions like so far? Like any more questions? Like it can be about. Hopefully this all makes sense. Okay, so, logger. Okay, so so once we get to the logger, we can like call a bunch of stuff like logger dot. Oops. So get summary statistics basically gets the summary statistics. But something even more cool is here. Watch this. Graph statistics. Let's graph our statistics. Hopefully this will run. If this is a oops, no. Oops. Demo. Okay, we're running our demo. See how this does.
So is your portfolio in the green?
What?
Uh,
My
are
portfolio.
you, yeah.
My personal portfolio.
Yeah.
Shit.
Uh-oh. Num trades equals 0.
I think I'm.
Oh my.
Oops. Put them on. I swear I'm logging. Yeah, I'm just gonna copy this one. Change plans. We're doing.
Probably an import.
Okay, screw that. Okay, so this is okay. This is my backup copy. This is the same thing. This is exactly the same thing, except. So this is the same code. Okay. You guys didn't see that demo. Okay. Well, you guys did see it. Okay, just pretend this is a demo right now.
Okay.
Because this is like basically the same code. I'll have to figure out. Okay, so for this one, we're doing 10 days and 100 days. Okay. Let's see how this one does. 10 and 100 days. There's usually like 2 windows that open up. It's super weird. Okay, so yay, we lost money.
Oh no.
No. Here's what I say. A losing strategy is profitable once shorted. That's what a wise man once told me.
Ah.
Okay, so let's go over. Okay, does anyone want to look? So let's look at this distribution. Does anyone want to give some comments on what they see in this distribution?
Oh, we can only see the IDE.
Oh shit. Oh yeah, it's a new window.
Oh, you have. Okay, I didn't see any.
I have a matplotlib here. One second. I wish I could just share screen. Like.
I think you can. Like, it's just desktop, right?
Oh really?
Yeah.
Okay, one second. I'm gonna figure out that later. Let's just. Can you guys see this now?
Yes, we can see.
Yeah.
Okay, so can someone tell? Let's do some statistical analysis on this baby. Okay, so can someone tell me something about the return distribution?
It's low. It's below. Yeah, we're making a lot of. I think. So there's like a spike at -200.
Yeah.
So I guess that means we had a lot of trades with a loss at that at that amount.
Yes. Yes.
Okay.
I don't know. I was more thinking about like how about the shape? Can someone tell me about the shape?
Oh,
No. Anyone take stats?
Well, it's
Like-
like a roughly normal distribution with
Yeah.
skew,
What
right?
really? It's skewed. It's pretty skewed.
yeah, it's pretty
Skewed,
skewed.
right? So what happens there? Like there's like different trading styles have different like distribution shapes. So like say if you're like I think Ernest P. Chan, the person I was talking about, he said that like moving averages tend to have like right hand skewed distribution,
Mhm.
while something like a mean reversion has a left hand skewed distribution.
I see.
So different. Okay, so different strategies, interestingly enough, have like different return distribution, and so something you notice with like a left-hand skewed, right-hand skewed distribution is that you can make a bunch of tiny profits. So like you gradual increase, but the drops can be quite heavy because like say you could bunch of like, because like the losses are, because like the gains are small, but there's a bunch of them. The losses are few, but they're large. So what that happens is that it leads to large drawdowns. And drawdown is basically the largest distance between a peak and a peak. Can you guys see my cursor?
Yeah.
So drawdown is basically like the distance between a peak. Like this would be a peak right here, right?
Yeah.
And this would be like a trough. It'd be the distance between peak and trough. And the reason that happens is because when you lose a lot of money in just a few times, like it is sharp drops. But when you have like something that is more left hand skewed, the losses are more frequent, but they're smaller. Then the drawdown is like it's not as drastic. Okay, let's go over the summer statistics. Okay, so we did 25 trades, profit, we lost money, win ratio. So something interesting that I like pulled from like what I studied about Renaissance technology is they try to find strategies that win like slightly above 50% of the time. And I think the reason they do that is because wait, my p-values. So the reason they do that because like when like there's a lot less drawdown when you win like half of the time because you don't really like lose a bunch of trades then make big trades that like recover the losses, and that's why they are consistent throughout the years. I don't think they haven't went 1 year below like 0%, and the lower end is usually like 30% returns. So our win ratio is awful, 3.32. You see, this is pretty interesting. Our average win is higher than our average loss. Like, this is like something that you can do. This is how statistics can lie. You can say your average win is higher than your average loss, but the thing is like, and then you can sell that to investors. But in reality, your algorithm actually loses money because the frequency that you win is way lower than you lose.
Right.
Okay, so Kelly criteria. What the hell? Okay, I think I need to fix that Kelly. So Kelly criterion is a. Does anyone know what Kelly criterion is? Okay, nobody answers. Okay, Kelly criterion is a metric used to measure what percentage of your portfolio should you put into investment based on the statistics. So you you see a bunch of statistics. It takes a bunch of these random numbers, like a bunch of these other numbers. I think average win, average loss, win ratio, a bunch of these numbers, and it like puts it into this formula, and it calculates what percent. So this basically, so it's telling us we should put 75% of our portfolio into this strategy. So the one problem, which is not a good idea because it's a losing strategy. So one of the downfalls of Kelly criterion is it only tells you, it is only valid when the strategy is winning. So that is one thing to keep in mind.
Right.
like when you're using Keller criterion, like you check that the profit is indeed above 0, so that, or else the Keller criterion is kind of messed up. Fischer Kurtosis. So does anyone know what kurtosis is? So say you have a normal distribution. You know those tails at the end? Like, you guys know what a normal distribution is, right? It's a bell curve.
Mm-hmm.
There's tails at both sides, right?
Mm-hmm.
And kurtosis is the fatness of those tails. So we're basically fat shaming these distributions. So like, you know, like the tails are very small. Yeah, let me just,
Hey,
yeah.
really fast. I was curious after this, could you kind of go over what the first graph means? Because I was kind of lost on that. Sorry.
Oh, okay. Oh, yeah. Sorry, I didn't go. Oh, I put a label there, but I should explain it better. Here, let me explain kurtosis real quick. So, I don't like that one. Yeah. Right here, you see that? So you can see here, like it's sharper peaks, but the blue line has a slightly fatter tail. And when you have fatter tails, you have higher risk because like a fatter tail on the left side, that means you have a higher risk because you get more trades that are highly deviant from the mean. And when that happens, you lose a lot of money on a single trade, but like a few trades. So when like a few of these large trades happen in succession, you have large drawdown. And so looking at our kurtosis value, so I think the normal distribution is like 1. Fischer Kurtosis. It's 3, right? Okay, so the Fischer Kurtosis of a normal distribution is 3. Ours is slightly lower, which is a good sign, because that means our tails are slightly not as fat, and that means that's good. Our standard deviation, okay. Skew, okay. Skew measures like how. It's pretty interesting. The skew value is pretty low. So let me go over what this graph is. This is the return distribution. So every trade is logged. So like say you have like, so right here, this is like one trade that lost us $800. Does that make sense?
Okay, so the x-axis is like amount gained or lost, and then the y-axis is amount of trades.
Frequency.
Frequency. Okay, cool.
So like here, yeah, this is a histogram, if you're familiar with that term. And so histogram plots like, it plots like a metric. So right here, this profit against frequency, like how often this occurs. Okay, cool. This is like a high frequency for losing $200. Okay.
Wait, but we don't like. But we don't like. It's not. None of these graphs kind of show where, or like if it was kind of what trades lost us that money.
Oh, no. Here in the second graph, profit over time, the nth trade. So here, so this is 0, right? Mm-hmm. So 0th trade, you're at $0. First trade, you lose $250. Second trade, you lose another $250, and you go down to $500, right?
Okay, I gotcha.
So you can see as more trades go on, pretty interesting. As more trades go on, like it loses more and more money. And this is like a sudden rise. Okay,
sweet. Thank you. I really appreciate you answering my questions.
Oh, yeah, no problem. No, I'd be a terrible teacher if I didn't. Okay, let's go over the... Okay, so, okay, are there any questions about the code? Like, how about, like, do you guys want to talk about, like, what pandas, like, is? Like, what a data frame is and stuff like that? Like, what other questions you guys have? Like, the data structures we used or anything in general? Are there any questions?
Yeah, can you do the back test for even longer? Like a longer period? Would that give
Oh
us
yeah, that's a good
more,
question.
would that give us
So
more data? Is that the idea? Like,
yeah, okay, so the back test for here is from January 1st, 2017 to January 1st, 2019, right?
right.
And so if we want to increase the duration, we can just subtract 2 years, right?
Or we can see how our strategy handles coronavirus.
Okay, yeah, let's do that. Here, do you want to give it? So what's today? 420, 21.
Yeah.
Let's do 420 in honor of weekday.
Yeah.
42020. That is kind of epic.
Yeah.
Let's do the start of the year. Start.
Okay. What's up with that?
Shit.
Line 38.
I think there's a few bugs in my stuff.
It might be like an issue with the library itself.
Yeah, it is. I wrote the library.
Oh, you wrote the library.
Shh, don't tell.
Oh, it's a cool library though. It looks cool.
It's because it doesn't make any trades. Sometimes it doesn't make any trades.
Okay, we got something
Fuck, it
now.
made
Oh,
trades.
it did even worse.
No, it only made 2 trades.
Oh, okay, yeah. So
So the
just
reason-
do like 2018 maybe or something.
Yeah.
Time.
420, 2018.
Yeah.
Yeah, so one problem, yeah, I need to fix it. So like what happens if you have 0 trades is like some of the metrics use the number of trades. Like
Yeah.
if I,
Makes sense. Yeah.
yeah, and then like
Do we have a graph?
I made 2 trades here.
Why is it making so few? 2018,
It's
2015.
yeah, I'm doing 2015. Let's see how this is. It only makes a few trades a year.
Yeah. What
Buy one thing.
what can we change to like increase that? You know.
Oh yeah, we can add more stocks that we.
Oh yeah.
Add more stocks that we log.
So
Oh, we just lost a ton of money. So
yeah, is that $200,000?
Yep. Yeah, let me show you guys the graph.
Oh Lord. This is not a good strategy at all. Who thought of this? God dang.
Probably some retard. No, I'm just kidding.
Oh my goodness.
Hey, well, that's pretty interesting. Like it
just
goes
stop,
straight down.
If you just stop. at 32.
It's like stuck at 0 and then just goes straight down.
That's great. Oh, the Kelly criterion says we should invest 700%.
What the hell?
Or is that 7%?
Oh,
don't know.
I think it's because the Kelly criterion. It only like
Works if it's.
it only works when your trade is winning. I don't think it like counts for the fact when your trade is losing.
Wow,
So-
it really made no trades which were like profiting. Like
Yeah,
no,
the return distribution has nothing.
on the right. Yeah.
Yeah.
How
For the
is-
profit over time graph, is the flatness at the start, is that just because it's buying and holding and then waiting to sell?
Oh, I think it's if you see here, there's a bunch of zeros here. That means it buys and sells like when the stock doesn't move. Like it probably like one day to the next, it doesn't do anything. Yeah, we can change the stock. Let's change the stock here. Do you guys want to give me stock to help?
You should do like Tesla or something.
Yeah, I was just gonna say Tesla, but I wanted to. Yeah, actually. Yeah, I think
okay.
it is not very good, I guess.
Yeah.
Hey, this is something weird. Here, watch this.
So
Huh?
is that like shares owned thing just not working, or why is it buying so much? Tesla.
Huh? Buying so much Tesla?
Yeah, because I
Tesla's
thought
like,
you
what, like
limited it
200
so it
bucks?
could only buy 200 shares.
I can buy it and that's.
Yeah, you can sell it back and then you can buy more. So
Oh, so it's buying and then selling for a loss and then buying again.
pretty much, yeah, it never learns. There was another strategy that I've read about. It's like something about like picking the top 5 stocks that are super high and entering short positions, and then picking the lowest 5 stocks or something and entering like whatever that other position is. But like I forgot what it's called. Like it was similar to a crossover, but I'm not sure what it is.
Can you repeat that?
Like I was wondering, there's another strategy like where you buy these really like where you buy stocks which are at like their extreme prices or something. Like
Oh,
either-
that's mean reversion. Yeah,
Oh,
I know
that's
what
the
you're
one.
talking
Yeah, that's
about.
what I'm
Mean
talking about.
reversion.
Yeah.
Hey, this one made $2,000 here. This one made $2,000. So you know it's working. It is logging trades. I mean logging problems. Made $2,000 at one point, but then it just
It YOLO'd it all.
yeah.
And all lost.
Oh. Yeah, well, let's use my slide. Oh yeah, here. Let me give you guys a poll.
So you made a library. Are there other libraries like it? You know.
I don't know. I actually don't know. I probably should have.
It seems like something people would make, right? Because it seems like
Yeah, they probably are, and they're probably better than mine. But the thing is, like, you know that like thing that I showed you. You know, like the statistics and all that, like the kurtosis, the Fischer,
yeah.
like the win rate. Like the problem I had is like a lot of like other tools didn't have those. But like I thought, you know, like analyzing the distribution, in my opinion, is probably the best way to like determine how good a strategy is and how like the risk of it, because like and like understand the fundamentals, like how it works, because like some algorithms they lose a bunch of money, like a bunch of little trades that lose money, but then they have like big trades that like cover the losses and make profit.
Yeah.
So the distribution can tell that information, and so I wanted I wanted to be able to visualize return distribution and a bunch of stuff like that.
Yep. Makes sense.
Okay, can you guys go to this poll and tell me what you guys want for the next lesson? Okay,
Yeah.
I'll read it. Do you guys know how to enable chat? I don't know how to enable chat.
Yeah. So I think like you probably can't do it right now, but like you have to like go to the settings like on the Zoom website, and there's some stuff. But yeah.
Oh, I see.
It's like Zoom.us. Yeah. Okay. Nice.
Oh shit. Wait, let me let you guys all get the poll.
You can just put it in the Facebook chat, I guess.
Oh yeah, that's cool. You're smart, man.
Wait, is there a way to get invited to the Facebook chat?
Oh, you can just join it. Go to ATC at UW at Facebook on Facebook.
Oh, okay, cool.
I don't think there's like I think you automatically get a join. Yeah, let me post the slide too.
This is the Algorithmic Trading Club at UW Public Creek.
Oh shit, I should put that GitHub repo.
So some of the current like best strategies, so they incorporate news and stuff, is what you're saying, right?
That could be part of it. The best strategies right now are ones that like I like there's this thing. I think the best strategies are arbitrage, where you find like an inefficiency. So say like you're selling Apple, like Apple is like $220 and like on one exchange, right?
Oh, I see. So
But
you sell it off at a different exchange for a better
yeah.
rate. That,
Well,
that's disappointing. That's some of the best strategies.
well, you don't lose money, right?
Oh yeah, because you don't have to sell it at a worse rate ever, right?
Yeah, like it's just free money. But the problem, like that's just one example of arbitrage. There's like a bunch of arbitrage. Like so, you have S&P 500, right?
Yeah.
And so it's comprised of stocks. So something you can do is if the S&P 500 index is like too expensive, right? You short the S&P 500 and then you buy the 500 underlying companies, and you wait until their prices intersect again. That's another arbitrage. It's free money. Like
What, really?
but the thing is, like, it is free money. So you know what happens? HFT firm terms, they pay like they spend like $100 million developing infrastructure so that they are the first to get those trades, right?
Oh.
If it's free money, then all the investment firms, what they're gonna do is they're all gonna compete for it, right?
Right.
So they're gonna fucking spend like $10 million just to shave off 0.0004 milliseconds just so they can be first. It's actually crazy.
So like us, like common folk, can't really get any access to that, I assume.
Yeah.
So like, how do you make money?
Yeah, for common folk like us,
Yeah.
just trade options.
Really? Why options over stocks though?
Like you don't need it. Have you seen Wall Street Bets?
Yeah.
You can make some leaked gains. That's terrible idea. It's probably a bad idea to trade options when you don't know what you're doing.
Right.
For us, I think like buy and hold, because then you don't have to pay attention.
Yeah, for sure. That's a smart
Like
idea.
trading, I think like make sure like shorter.
What?
I don't know.
Okay.
I like. I think for myself, what I do is I trade large caps.
Yeah.
And so like if it like they usually move for like 1% to 2%. So I profit like 2% every day. Like
Okay.
if I find a strategy. Well, I don't always profit 1% to 2%. Sometimes I profit like 4% when I'm lucky.
Okay, but
So I could trade Costco or something like that.
okay, yeah. So overall, like you're still like making profits, right?
Yeah, but
Okay,
like,
that's good.
but the thing is, like, you have to remember to like sell out positions. Like I'm on like PDT. If you know what PDT is, it's pattern day trading. It's pattern day trading. When you have like less than 25K, you can only make 3 trades in the past 5 days.
Oh, okay, gotcha. Yeah, makes sense. Yeah, you got to be a day trader for that. Yeah.
Yeah. So I have less than 25K. So what happens is like I buy it. I wait until the next day and then I sell and then I lose money. So like, because like I don't want to use up my PDT days.
Oh, I see. So why don't you just get more than 25K in there?
Oh yeah. It's just that easy. Like homeless people should just buy. Yeah. Like homeless people should.
No, dude. Listen. So you're making money off your strategy, so you should be at 25K by now, right?
Well, I have school.
You have school.
Yeah.
Oh, fair enough. Okay, understandable.
Yeah.
Tell you what, I can just throw you some money, and then you can like multiply that.
Well, there's probably a bunch of like regulations. Yeah.
Oh yeah, probably.
Yeah. If you're willing to, yeah, sure.
Or you just send me your strategy, and I'll.
Is anyone still in here?
Yeah, there's Robert.
Okay. Does anyone else have any questions? Oh, Robert. Robert, do you have any questions?
It's probably just AFK, maybe.
Oh yeah. It's probably muted me. Okay. Do you have any other questions?
Nah, man, that was good stuff.
Okay, I hope you learned a lot.
Yeah, for sure.
Yeah,
It's cool.
I'm trying to get used to Zoom. It's kind of, I got the. It's kind of sketchy at first, but I got the hang of it later.
So
But thanks
like,
for coming. Thanks for coming.
yeah. When did you get into this, by the way?
The club, or
Like just the stuff, you know?
I don't know. Can't remember. I think in high school. I just read a bunch. So what I did was I just like read a bunch of articles,
Uh-huh.
but I didn't do anything. You know.
Yeah.
I just read. I was like, but then like I joined ATC, you know, the club that are you in ATC? Are you in the group chat?
Yeah, I'm in the group.
Yeah. So yeah, I joined it like starting during the fall, and was involved in it. And then like just messed around, built some stuff.
Nice.
Yeah. Are you trying to get into like algorithmic trading and stuff like that?
Yeah, I mean, I think like I'm just trying to find a good strategy. Like right now, I'm just
yeah.
like throwing shit around on Robinhood, you know.
Oh yeah.
Yeah. Like, you know, the coronavirus like ate a lot of my gains, you know.
Oh yeah, that's true.
I'm just trying to buy the dip now, but maybe the dip's passed. I don't know.
Oh, yeah.
Yeah.
It's always hard to know, but like the thing is like you can't predict the stock market, but you can't predict it every time, but you can predict it. You can try to predict it more. More that you're right than you're wrong, because like if you can always predict the stock market, then it's impossible to always predict it. But you can like assign that you can like predict what the probability of making money is on a trade, and you just like do 10 trades and hopefully that the profits and losses average out so that you end up on top.
Yeah, for sure. Where do you think is a good place to start reading about this stuff?
I just traded random stuff on Robinhood. Like I think the best way, like you watch videos, they all have like these webinars that they're trying to like they're always trying to sell the course and stuff.
Yeah.
Like, if you have a successful strategy, if you like reveal it to the world, it's not going to work anymore because everyone's going to do it, and then you're trying to compete. So you just look at a graph and just try to find patterns, and then you log those patterns, like put it in an Excel sheet, like log the pattern, like say, like you have a W shape, right? And you buy when it looks like a W, and then you just like, and then you like have like a sell point and like the buy point and the sell point, and see like how many times it makes money. You can apply the Keller criteria, like if you, and then you can like do like see if it is an indicator that the stock is more likely to go up than down. You can try it with like $50. Like once you like find a strategy that you think might be working, you just like buy like 1 or 2 shares of a stock that fits your pattern. Yeah. Oh, right now I'm working on a thing that will help people screen like stocks. Like, cool. I'm gonna release it like probably like in a few weeks. I'll put up the group chat so you can look at that. And then you can do some of the Keller criteria and statistics. You can look at the slides or like look at the graph and see all the measures and like look what they mean. And like apply it to your stuff. And then...
Sure, man. Thanks.
Okay, I hope you learned a lot.
Yeah, I did. Thanks for your time.
Thanks a lot for coming. It was in the first 10 minutes, I didn't notice anything. I was like, oh shit. I'm gonna be sitting here talking to myself. But okay. So,
wait, sorry to ask this, but is it a public group on Facebook? The Algorithmic Trading Club at UW?
Yeah, let me. Shit. ATC. Here, let me. Yeah, just type in Facebook /ATC UW.
Facebook /ATC UW.
Or is it /?
//
Oh, // okay. And then I just. So I just like the page or something?
Following. You can just follow it, like and follow or something like that.
Okay.
Events.
Yeah, I thought that there was a public group too, and I requested to join that one, I think. So.
Oh, did you get in? Like, I think, yeah, I'm only following it.
There is another one too, I think.
Oh, that one's old.
Oh, that one is old? Okay.
Oh, there's another one?
Yeah, I think they like. I think I don't know. The one that you're on right now, the ATC dub.
Uh-huh. So
Oh,
this is the most recent one then, and
yeah. Are you in the messenger group now? Like,
I
once
don't
you follow
think so, not yet.
it? Here, let me try to find. Yeah, I could add you to it. Let me add you real quick.
Oh, okay, cool. It's Robert Burris, R-O-B.
Oh wait, I could.
Yeah. With an I,
Stupid.
sorry. 2 R's and 1 I.
Oh,
And then we got 1 S. There you go.
Yeah.
Yeah, that's me.
Mhm.
all right. I'm out. Thanks.
Okay, see ya. Thanks for coming.
Okay, cool. Thank you. Do you know when the next one is? The learning
Oh,
streak
next
is gonna
Tuesday.
be? Next Tuesday? All right, cool. Thank you.
Okay, see ya.
Yeah.
Wanna play some pool, brother?